So it's time for another video where I go over some very popular trading maxims. Now, what is a maxim? A maxim is a phrase or a saying. It's a proverb, if you will. It's something people often say, and it kind of is something that's a rule or a guideline. It's something hopefully to guide you in the right direction on something. So with trading maxims, these are phrases designed to help you in your trading. But if you're a new trader, many times these new traders will hear some of these very popular trading maxims and they misinterpret them, or sometimes they interpret them to actually mean exactly the opposite of what they truly mean. So let's go over some of these trading maxims today. And the very first trading maxim is, when VIX is high, it's time to buy. When VIX is low, it's time to go. So what does this mean? Well, VIX is the S&P 500 volatility index. It's basically the volatility of the S&P 500. It's the volatility of the stock market. So when VIX is high, there's a lot of volatility. There's a lot of fear. There's a lot of uncertainty. There's a lot of turmoil in the market. And when volatility is high, when VIX is high, there's opportunity. There's real opportunity, especially buying opportunity. That's why the phrase is, when VIX is high, it's time to buy. It's because typically when VIX is high, the market is in a sharp fall, right? Typically it's during a crash, especially think of COVID in 2020, where the market loses like 30% of its value over a couple of weeks, right? And that's the time to go in and start scooping up things at a discount. When VIX is high, it's time to buy. Conversely, when VIX is very low, say, 15 or below, there's not a lot of opportunity in the market. You're not getting a lot of stocks, for example, at a discount, because when VIX is low, the market tends to be drifting higher. It's tending upwards typically when VIX is low. Like right now, the market, it's essentially at all-time highs. Is now the time to sink all of your money into the market and scoop up all of these stocks? No, I mean, if you want to, you certainly could, but you're not getting a discount. I wouldn't say it's necessarily the best opportunity. I would keep some money on the side, and because VIX does not stay depressed forever, eventually we're going to get a pullback, a sharp pullback. VIX will explode higher, and all of a sudden that money you have on the side, that's the time to jump in and get those sweet, sweet discounts that you've been looking for. Maxim number 2 is, the trend is your friend. Now, I think that is pretty self-explanatory. I think we all know what that means. The trend is your friend, meaning if a stock is trending higher or trending lower, it's been directional for a while, the same direction for a while, don't step in front of that train. Go with the trend. The trend is your friend. Maxim number 3 is, the market is always right. So many traders, they form their own assumptions. They have their own directional assumptions. They predict certain things are going to happen in the market based on their fundamental analysis or their technical analysis or whatever macroeconomic news is out there, and they have these predictions. And then most of these predictions do not actually come to be. So don't be stubborn. If your assumptions turn out to not be correct, and the market will let you know, right? If I'm thinking, hey, you know what, all of this news that's in the market right now, I think the market is about to crash. And, for the next 6 months, the market does nothing but stair step higher. At some point, I have to admit that whatever assumptions I had were completely wrong. The market is telling me I'm completely wrong. So don't fight the market, right? And remember, the market is always right. Maxim number 4 is, the moment you accept the risk, you will be at peace with any outcome. So this is pretty self-explanatory too. When you go into a trade, know the risk, accept the risk. If you can't accept the risk of any trade, you should not place the trade, right? This is like the first rule of trading as far as risk management. Know the risk on the trade, and can you accept that risk or not? If you can't accept the risk, don't take the trade. If you can accept the risk, meaning the possible losses for this trade are something I can stomach, I'm perfectly okay with taking that potential loss, then I can be at peace with that trade. I can be at peace with that outcome should it happen, because I went into the trade knowing that that loss was possible, and I was okay with it. Maxim number 5 is not just a trading maxim, but it is a life maxim, and that is, expect the worst and you will never be disappointed. Seems pretty obvious what this is about, right? Go into anything, not just a trade, but anything in life, any endeavor in life. Go into it expecting the worst, right? And then you will never be disappointed. Make sure that when it comes to all the possible outcomes of any event in life, you've considered every possible outcome. And then when some crazy, unexpected event actually happens, it's not unexpected to you because you considered that event, so you were ready for it. You weren't blindsided like so many people in life often are blindsided by things that happen to them. Maxim number 6 is one of the most common things you'll hear in trading circles, and that is plan the trade and trade the plan. So when you're trading, you should always have a plan. You should actually have a plan. Write it out if you need to, or if you're somebody like me that's traded for a long time, I have trading plans that are just ingrained in my head. Every time I trade a certain strategy on a certain underlying, I already know exactly the days to expiration I want to trade, what kind of IV I need to make that trade. I already know the deltas of the options I'm buying or selling, right? I have a plan. So I've planned the trade. And then I need to make sure that I actually trade the plan, meaning if I have a plan that I know works, has positive expectancy, stick to the plan. Never deviate from the plan, because when you deviate from the plan, that's when all of a sudden some weird things start creeping into your trading, where all of a sudden you're taking more risks than you really should, is because you're not following your plan. You've kind of strayed away from the plan, and that's going to get you in trouble in the long run. Maxim number 7 is be fearful when others are greedy, and greedy when others are fearful. So this is going back to, when VIX is high, it's time to buy. When VIX is low, it's time to go. Same thing with when others are fearful, you should be greedy. So when others are fearful and they're pulling all their money out of the market because there's a lot of volatility and turmoil, that's when you go in with your money and you start scooping up things at that discount. So when people are fearful, you should be greedy. And when other people are greedy, which is typically low volatility market environments, everybody's just buying anything and everything they can get their hands on. They're not being selective at all. They're just buying everything that's out there in the market. That's when you should pull back a little bit. You should be a little bit more fearful in that circumstance. And this is kind of common sense when you think about it. Remember, 95% of traders lose money in the long run. So you never want to be doing what everybody else is doing in the market. When you see everybody else being fearful, you should not be fearful. You should be doing the opposite. You should be scooping up all of those stocks, right? And if you see everybody being greedy and buying everything, again, most people lose money in the stock market. You don't want to be most people. So when they're buying everything, you should be a lot more selective. Maxim number 8. Don't confuse being right with making money. So a lot of traders, they really don't care about making money. Well, I won't say they don't care, but many traders just want to imagine themselves being a good trader. They want to be right. They want people to see them as having some kind of predictive power over the market. Like, I guess this stock was going to make this move over the next 2 months or whatever it happens to be. And, they want to be right. Whether they make money or not, they just want to be able to tell people, hey, I predicted that. I got that right. Whether they lost their ass off on a trade or not, they just want to be right rather than make money. And that's not the way real traders think. Real traders don't care about being right or wrong. They care about their P&L. Maxim number 9, gotta be in it to win it. So this is for those people that sometimes will pull themselves completely out of the stock market. This is not something you ever want to do because you gotta be in it to win it. If you're not actually in the stock market, if you have no money at all in the game, guess what? You're not winning the game. Now, I know some people will be like, well, I'm not losing the game either if I'm not in it, but that's not the way a trader should ever think. As a trader, you should always be thinking, hey, I need my money working for me. I need it constantly generating income for me. So if you're not in the game, you're not generating any income. You say, if you're not in the game, at least you're not losing. Well, in my opinion, as a trader, if you're not in the game, you are losing, because even though, technically, you're not losing money, but when you really think about it, due to inflation, right, you are losing money. You have to always be in the game. Now, that doesn't mean that you necessarily have to be 100% fully into the game with your capital. You certainly can hold some money back. You can be more invested at certain times in the market and less invested in other times, but you have to be playing the game in some form or fashion at all times. And the 10th and final maxim is, it's always better to buy a good stock at a bad price than buying a bad stock at a good price. And this is 100% accurate. There's nothing wrong with buying good quality stocks. For example, your Mag 7 stocks, Apple and Meta and Microsoft and Nvidia and all of that stuff. It doesn't matter if you got a bad price, you're still holding a really good quality company. Whatever the price you got into, that company almost certainly is going to appreciate in value over the next few months or the next few years, however long you hold those shares. You're going to make money, right? So it's better that you bought that good stock, even if you bought it at a bad price, than buying a bad stock at a good price. So a bad stock would be your meme stocks, your penny stocks, your garbage companies, those companies that are in a sector that's not a hot sector anymore. Think of, a lot of your traditional automotive companies. They're doing really bad these days. Your dollar store companies, those things are doing really bad these days. Pharmacies like Walgreens and CVS, those things are doing horrible, right? I don't care what price you get to buy those shares. I wouldn't want to hold those shares of those companies anyway, right? So it's better always to be in a good company rather than a bad company, regardless of whatever kind of discount on the price that you may have got. So there you have it, 10 popular trading maxims explained. Now, before I go, I do want to mention, check out my book, The Super Wheel Option Strategy, which is available on Amazon. You'll actually find a link to this book in the show description. Also, consider subscribing to the DT Options Discord. You'll find a link to that in the description below as well. Peace, guys.